Hello, everybody. Um, Welcome to another day of class. And today we begin our discussions on financial literacy. So the remaining sections, actually sections 10, 11, and 12, will constitute our conversation on financial literacy. So today we're going to be talking about credit cards. The next thing we'll be talking about will be loans. All right, so where we look at mortgages and other loans, all right, car loans and all that. And then we will be looking at retirement and saving plans in section 12, all right, and that will end unit 2. Now, at the end of these three sections, we are going to have a project, okay, a financial literacy project, and so you have to take note of that. So you can begin to review the material to see how you're going to go about the project, and then I would take your questions, okay? All right, so today we are going to be talking about credit cards. Now, this is a credit economy, and it is important that you know about credit cards. Now, before we even begin the discussions, let me differentiate between a credit card and a debit card. These are the two main financial cards that we have, right? A debit card is usually a card that is given to you, okay, when you open a bank account, and the money on the credit card is your money, like money that is ready in your account, and you cannot go, usually you cannot, unless you have an overdraft protection, you cannot go beyond the limit of how much you have in your card, in your bank account. Now, for a credit card, the money on a credit card is a loan, all right, from a financial institution. So this is the distinction. And usually purchases on these two cards are different. They show differently. So if you use a debit card to make a purchase, it shows as a negative. On the other hand, if you use a credit card to make a purchase, it shows positive. And then when you try to pay off a balance on the credit card, that shows as a negative. Now, if you have the two cards, go into your account and see the distinction, how they work. Is that okay? Now, let's get into our conversation on credit cards. Now, why is it important to have good credit, and how do you establish it? I'm sure we've had this over and over again. So how do I establish a good credit? People talk about you need a good credit to be able to buy a home. You need a good credit to be able to buy a car. How do you establish it? We are going to, look at how you can do that, right? Now, what is the fine print that comes with a credit card? Now, every credit card comes with a fine print, the agreement, the credit card agreement, and we are going to look at a typical credit card agreement and see how you'll be able to, do your own math, do your own numbers to check, right? And it is important that you read every fine detail on the card, because as the saying goes, the devil is in the details. So we will look at a typical credit card agreement. Now, this activity, like I've already mentioned, is our discussion about financial literacy. So we work through various credit card scenarios and see what happens quantitatively when only the minimum payment is made on a regular basis. Is that okay? Sweet. Now, these are our learning objectives. We're going to look at how you can find the monthly finance charges given an APR. And an APR is the annual percentage rate. And understand and explain the terms and conditions of a credit card agreement. Communicate what happens quantitatively when only the minimum is made. All right, and then we're going to compare different APRs and quantify the impact of changes in rates. And we have, as we have always done, we will look at how we can use Excel to do Excel to do the calculations, right? Now, and then finally, we will explain the importance of a good credit and how to maintain it. Very significant, okay? Everybody needs financial independence, all right? And these discussions will lead us to be financially independent and to make wise financial decisions. Let's go. Are you ready? So if you are with me, we are on pages 129 of your textbook and let's get the discussion going. I'll be reading a lot. Okay, so now what is good credit and is it important? Now, whenever a person pays a utility bill, makes a car payment, or charges a shopping trip at a mall to a credit card, he or she is establishing a credit history. All right, so this is how you establish credit. Now, there are several companies called credit bureaus that track the borrowing and payment habits of Americans. These credit bureaus maintain databases of this information to create a credit report that potential lenders, potential utility companies, potential employers, insurance companies, and others may access to help determine the creditworthiness of an individual. So this is how you establish a credit, and the credit bureaus are checking how you do your expenses. Now, based on the information in the credit report, each person is assigned a credit score. Okay. Generally between 300 and mid 800s. A low credit generally indicate that an individual has very poor payment habits or payments are often late. Too much available credit or too many credit cards, for example, or a little to no experience with credit altogether. A high credit score would typically indicate the individual rarely, if ever, has a late payment, has much more income than credit, right? Now, potential lenders use this credit score to decide whether or not to lend to and set the interest rate on the loan. In general, individuals with higher credit scores are considered less of a credit risk and are often given lower interest rates on loans and credit cards. Okay. Now, anyone may obtain free copy of his or her credit report, okay, which does not include the credit score. So this is a link that you can use to obtain your credit report, and that usually does not include your score. So these are the basics, right? And this is what you should understand, how you can establish a credit card, all right? And why is that important? The importance is that you can get a lower interest rate on loans. Okay, nice. Now, having done this, we are going to look at how different APRs impact your payments. Now, credit cards have varying rates of interest. Let's consider the impact of different annual APR, annual percentage rates on a carryover balance of 1,000. So we're going to look at the impact on different APRs. Now, we are going to use this sample calculation to do the rest. Now, anytime you hear APR, and this is the word annual, this means this is what per year, for the year. So now, when we'll be using finance charge a lot, and when we talk about finance charge, it's about the monthly payment or the payment. So to find the finance charge, you have to first of all change the rate to a decimal, and you divide by 12, because how many months do we have in a year? We have 12 months, okay? So you divide the rate by 12. So that actually gives you the monthly rate. Then you multiply by the carryover balance, and this is how much you pay on the loan monthly. So this 10% is for the whole year, but when you divide the rate by 12, that gives you the monthly charge, and that's what we call the finance charge. Okay, so if you add the finance charge to the balance on the card, that gives you how much debt you have on the card. Now, let's do for 15% and 20%. Okay, so we first of all change the rate to a decimal, and then we divide by 12 just so that we can get the monthly rate, and then we multiply by the balance. Okay, and now we add that to the balance, and that gives us that. Now, we want to use this to find how much more interest accumulates with a 20% APR versus the 10% APR, and the difference. So we just did the difference between the two, right? The 10% and 20%, and the difference is 8.34. So the rate really matters, right? So the higher the rate, the more likely you are you are to pay more, depending on the balance or the carryover balance on the card. All right. Now, credit cards and finance charges. A credit card allows an individual to borrow money on a short-term basis to pay for goods and services with the promise of payment in the future. Credit cards afford individuals a great deal of convenience by removing the need to carry cash for purchases and provide an opportunity to establish a favorable credit history. Now, as with any type of loan, the lender or card issuer charges the user a finance charge in the form of interest on the unpaid balance of the credit card each month. This interest rate is the APR, and usually much higher for credit cards than other types of loans like mortgages or auto loans. So credit cards usually have higher APRs because they are short-term loans. All right, so if you are not careful, you may accrue more debt on credit using a credit card than even paying on your car loan. Okay, and credit APR, credit card APRs go as high as 29.99%, and I will let you know in a bit how that can happen. All right. Now, the lender will not charge a finance charge if the entire balance of the credit card is paid before the monthly due date. In addition, almost all credit cards have a grace period in which no interest is charged between the purchase date of an item and when the bill is received. So what happens is, so if you spend, say, $200 on your card, and your due date, you're supposed to pay, say, on the 30th of the month, and you're able to pay off the $200 before the due date, you don't pay interest on that balance. Is that okay? Good. Now, credit cards and finance charges. Now, let's consider the finance charge on a credit card with a balance of $1,000 and an APR of 16.99%. Okay, that will be our first consideration. Now, credit card companies are only allowed to charge the user interest for the period of time that the money is borrowed. So if you borrow the 200 example, so that the interest is only charged on how long you borrow that money. Okay, so if you carried over a balance of $150, the number of days it took you to carry over that balance will be, that is the time, that is the interest that will be charged on that period. So if it took 5 days, usually they will divide, and we will do the division right here for you to see how this is done. So compute finance based on a daily interest rate. So if you want to find a daily interest rate, what you have to do is you have to divide the APR by 365 days. All right, that gives you the daily APR. Now, for the number of days that the money is in use. All right, but however, to simplify our calculations just a bit, we will use the monthly interest rate, the APR divided by 12. So for this, we want to simplify our calculations a little bit. So we are just going to stick to the monthly APR, right? So we are going to divide the APR by what? By 12. And assume that we carry over a balance on the card from the very first day of the month until the very last day of the month. Now, in this example, the monthly interest rate for an APR of 16.99% is, so now, if you want to find the monthly interest rate, what we do is we change the APR to a decimal. And how do you do that? So if you have, and we did that at the very beginning of this class, how we can change from percentages to decimals, right? So you divide 16.99 by 100, and that gives you that. Please, I'm going to give you a caution right here. So this gives you what? The monthly interest rate. Now remember, percentages must be converted to decimals, to a decimal format before they are used in the calculations. Now, do not round these rates off before completing the calculations. Please do not, okay? Leave all decimal values in your calc. So if you check, when we divided this by 12, you had to write everything. I know you are used to trying to deal with lesser figures. You want to round off, don't round off when you do this division. Make sure you use every value, okay, unless otherwise stated. Now, so here, we want to do these calculations. So we want to use the information to think through these, through more examples. Now, find the finance charge for a balance of 1,650 with an APR of 23.99. So find the finance charge, okay? So what do? First of all, change this to a decimal, and that should give you 0.2. So if I change that to a decimal, that should give me 0.2399. Now I will divide that by 12, and then I'll multiply by the carryover balance of 1,650. Okay, and what do I have? So that is my finance charge right there. Is that okay? Now find a finance charge for a balance of 1,650 with an APR of what? 15.99. So therefore I will do 0.1599 over 12, and then I'll multiply by the balance of 1,650, and that will give me my finance charge. Now we want to look at what difference did the lower APR make in the finance charge. Okay, so we find a difference, and the lower APR resulted in a decrease in the finance charge by $11. Okay, so as you can see, a lower APR is usually preferred, right? Good. Now, so here in the credit card balance, so if the credit card balance is a 0, what should the finance charge be? So if you haven't used your card, you don't, there shouldn't be any charge on your card. But usually some credit cards, you have to pay annual fees, being just keeping the card. At the end of the year, you pay, but finance charges, you don't pay anything if you haven't used your card to buy anything. Now, this credit card has an APR of 17, and we want to find the finance charge on a balance of $100. Now, we want to plot this. Now, how do you do a plot? Your X and your Y coordinates, right? So we are going to put these on a graph. So if I spend $100, okay, my finance charge should be 1.42. So these are credit card balances, and these are the corresponding finance charges. Okay, so we're going to look at a number of these, and then we put it on a graph, and you realize that that is going to give us a linear graph. Okay, so if I spend that with the same APR, 17% APR, that is my finance charge. Okay, and that gives us a linear model, right? Now, if you want to construct the appropriate model, now this is our slope, right? This is the rate of change. So the APR divided by 12 multiplied by RX. So RX is the credit card balance. So typically this is what you have to use to find the finance charge all the time. So knowing your APR, and then you divide by 12, multiply by the balance on your card, and that gives you the finance charge. Is that okay? Nice. Okay, now let's talk about credit card fees. If every credit card user paid his or her balance completely every month, there would be no finance charges owed to the lenders. All right. Credit card companies are in business to make money. Now, they are not here to joke. All right. They are here to make money. So there are a variety of other fees associated with the use of credit cards. Now, if the lender does not receive the monthly payment by the due date, there will likely be a late fee of between $15 to $39. So note, the first fee you want to talk about is late payment fee. So you can have a late payment fee. Now, and your APR may increase dramatically. So missing a single payment can increase your APR, can result in an increase in your APR. Is that okay? Now, though the late fee is not significant, an increase in APR has a bigger impact in the long run. Okay, now having your APR permanently increased to as much as 29.99. Now, this is the highest APR on the market. Okay, so defaulting a single payment could increase your APR to as high as about 30%. And we are going to look at multiple credit cards. Now, because this information goes to the credit bureau, defaulting a single payment, okay, can result in an increase in your APR across all the multiple credit cards that you have. So if you have, say, a credit card with Chase Bank and American Express, defaulting with Chase Bank, okay, and then having your APR increased can also let your APR increase with American Express, because they all have access to your information, because the information goes to the bureau. So you might think you're just defaulting with a single bank, but before you are aware, your APR has been increased across the board with all credit cards you have. And that has a consequential impact. Okay. Now, any payment that is not received by the lender after the due date is considered late. So if mailing a payment, it is extremely important to allow extra time for you to reach the lender. Okay. So paying online is usually the best option. Okay, nice. Right. Now, another fee that can hit you is over the limit. Credit limit fees. Okay. Now, every credit card has a limit. So assuming your limit is, say, 500, and you want to buy an item that is worth $600. In most cases, some credit card companies will let it slide. They will let the transaction go through, and you'll be hit with an over the limit fees. Okay, we are going to look at typical instances like that. So many credit cards are issued with rather low credit limits, maybe between 300 to 500, in the hope that inexperienced card users will exceed their limit to generate additional income for the lender. Now, the over the limit fee can be an additional between $15 to $39 charge and may result in an increase in an APR too. So going over your limit with one credit card company, okay, may result in your APR being increased across the board with all credit cards that you have. Okay. Now, failure to make at least the minimum monthly payment can result in a similar fees and penalties. It is extremely important to read all the fine prints on the original card application and any subsequent material that the credit card company sends. So make sure you are paying attention to details and you're reading every fine print on that agreement before you sign up to. Okay, don't be in a haste to take a credit card. Anytime you have to take a credit card, make sure you are reading every detail. And after this, I will tell you my pet cheat, what I use to avoid paying, a lot of these charges and possibly even finance charges. Now, so this is a typical, what you see on your screen right now is a typical credit card agreement. Now, if you by chance have one, you can look at it. Now, APR of 15.99, and then they put it in parentheses, may vary monthly. Now, penalty APR, up to 29.99, depending on your credit worthiness. So your penalty APR, so if you default, if you have a late payment or over the limit, your APR could go as far as 29.99, and that is always stated. And then they tell you late payment fee, this is $35. Returned payment fee, so if you issued a check and it's been returned, $25. And over the limit is $39. So going over the limit of your card, you pay this amount. And now they try to give you some cashback rewards. Okay, if you shop at Walmart, if you shop at target, you get that, or if they give you some freebies, but that is not much, okay, compared to how much you'll be paying on charges and all that and fees. That is not a lot at all. Now, credit limit, your limit is based on your income and credit history. So some of them can give you a limit of 500, and they will tell you that if you're able to make your payments on time within, say, 3 months or 2 months, we will increase your limit, okay? So they usually will give you a limit. And note this information, note this closely. I'll be referring to it shortly as we do the numbers. Now, minimum monthly payment, $20 or 5% of your new balance, whichever is greater. Notes. Okay, I'll refer to that. Nice. Now, we are going to look at a very good friend of ours, Jennifer, right? And Jennifer has a new credit card with the above rules. So the agreement we just looked at was for Jennifer. Okay, now her credit limit is $500. She purchases $195 in school supplies at the beginning of the month. Now, Jennifer pays only the minimum payment, okay, of the purchase. Now, what is a minimum payment? So if you look at the agreement, that was what, 5%. The minimum payment is 5% or whichever is greater. So we do 5%. So 5% of her purchases. And she is supposed to pay this, the minimum, at the end of the month. So though she spent that, they give you a minimum, the minimum you can pay for the month. So because on the agreement, it said $20 or 5%. Now, whichever is greater. Now, 5% of the balance that Jennifer spent is $9.75. Because that is less than $20, Jennifer would have to pay $20 and not $9.75 because it's on the agreement. So you're not forced to pay all the amount you spent. You can pay a minimum of that. But because on the agreement it says that 5%, $20 or 5%, whichever is greater, because this amount is less than the $20, Jennifer has to pay $20 to the credit card company. Now we want to look at her carryover balance. So now she pays $20 and we take that out of what? The balance of 195. And now this is the balance she has to carry over, okay, to the next month because she paid minimum, she only paid the minimum, she is paying the minimum. Now we want to put this on the table. So the carryover balance now is $175. Okay, now we are going to look at the finance charge. All right, now let's not forget that she had an APR of 15.99. So we will change that to a decimal, divide by 12 and multiply by the carryover balance. So that is 2.33. Now, no new purchases are made. Other fees, no other fees. Now her new balance will be what? We have to add the finance charge to the carryover balance, and now her new balance is 177.33. Now we want to find the minimum payment. Now she has to do another minimum payment, right? And now we're going to do 5% on this balance. Because that balance is less than $20, she has to pay 20. So now we will take 20 out of that, okay? And now this is how much Jennifer would have to carry over to the second month. Are you following? Gucci? All right, nice. Now, suppose Jennifer has a new credit card with the above rules, which you have looked at. Her credit limit is 500. Now, what would Jennifer's cashback rewards actually be for the school supplies? And you remember on the agreement you saw rewards, and that is how much she will get out of cashback rewards, just 0.49 cents, less than $1. Okay. So this is for cashback rewards. For purchases are calculated only and the new purchases, a balance from a previous month is not subject to a cashback reward. So that is the policy on cashback. Okay. Now, assume Jennifer is so excited by the prospect of a cash reward that she purchases a $400 plane ticket to go to Cancun, Mexico for spring break. What would Jennifer's cashback reward be for the plane ticket? Now, this is how much Jennifer gets on cashback reward. And is this fair enough? Certainly not, right? Now, look at what has happened to Jennifer. So Jennifer has now exceeded her credit limit. The credit card company can charge an over limit fee and increases Jennifer's APR to 29.99. So Jennifer did a single purchase. She actually overspent her limit. She went over the limit of the card, and now her APR has moved from 15.99 to 29.99. Now we want to update the table and see her new circumstance. So now the new purchase is that, okay? And the finance charge, we will now use the 29.99 APR divided by 12 multiplied by the balance. Okay, the new purchase is that. So other fees. You remember other fees? Do you know what other fees are? So she went over the limit, and over the limit fee was $39. If you go back to the agreement, you see that. So that has also been slapped on her. Now we want to put all these together. Her new balance will be the finance charge plus the ticket to Cancun and then over the limit. Now look at that. She has a balance of 600, but the limit on her card was just 500. Okay. Now her minimum payment, 5% or whichever is greater. Now we do 5% on this balance, and that is 30.01. Now it's greater than 20, so she has to pay that 30.01. Okay, so you have to really pay attention to the fine details on your card so as to avoid these unnecessary charges. Nice. How much has Jennifer earned in total from cashback? Isn't that a harrowing experience? He's like, oh my goodness, look at all the money. Now, how much has Jennifer paid in finance charges and other fees during the first 2 months? So the first 2 months alone, Jennifer is paying $45.26. Okay, and she's screaming all over, shut up, take my money. All right, so if Jennifer can't make her minimum payment for month 2 on time, what will her late fee be? What do you think? Now look at that. Look at that. Her late fee will be an additional $35. Okay, and they are going toe to toe with the agreement. No considerations. Okay, so now learning from Jennifer's experience, we want to see balancing multiple credit cards. From Jennifer's experience, it is fairly easy to see how challenging it can be to successfully manage a single credit card. Just imagine how complicated it can get if one has several credit cards. Now, all credit card companies report customers' payment habits to the credit bureaus, and I've already mentioned that. A single late payment to any credit card company can result in an automatic increase in all the APRs for the other credit cards as well. Financial matters can rapidly get out of control when this happens. Now, let's do a quick recap. What we've learned about credit cards so far. Credit cards can be an extremely convenient way to make purchases. They come in handy during emergency situations. However, they are only truly convenient if you can pay the balance in full each month. Again, if you can pay the balance in full each month. Even if it's impossible to pay the balance in full, it is a good idea to pay as much as possible. Okay, and we will look at the impact on just sticking to the minimum, paying the minimum, or doing the minimum payment. We'll look at that soon. Credit card users should always be aware of payment due dates, late fees, and over the limit fees. So you have to be aware. Okay, be aware of these fees and make sure you don't default. Now, it is very important to read all information from the credit card company very carefully. Understanding credit cards and associated terms and conditions can make a difference in financial stability and success. Okay, you don't want to be battling with debt all your life, so you have to pay attention to these details, and you will live a peaceful life. Okay, nice. Now, making only the minimum payment, and this is where I gave you the condition a while ago that you have to try, if you cannot pay off the amount in full before the end of the month, okay, make sure you pay as much as you can. And we're going to look at the impact of just paying the minimum. So if you're keeping a certain balance, the credit card companies requires you to pay at least a minimum, and let's see how that works. All right, now assume that the credit card has an APR of 22.99 and a minimum payment of 3% of the balance each month. Now, if the balance at the beginning of the month is 3,000, there are no other fees or charges made during the month. We want to compute for month one, okay? So let's look at how we can do that. So the finance charge, so for the finance charge, you have to use this APR, right? You change that to a decimal and divide that by 12 and multiply by the balance. And that gives you the finance charge. Now the new balance. So for the new balance, you have to add this finance charge to the carryover balance. Is that okay? Now the minimum. So this will be your balance, the new balance, but the minimum you can pay, you have to do 3% of that. That's the minimum you can pay. So if you have this balance, that's the minimum you have to pay for the month. If you cannot pay all the money in full, this is the minimum payment. Now the minimum payment covers the finance charge, right? Anything left over reduces the balance. How much does the minimum reduce the balance? So you realize that we added the finance charge to the balance, so that is incorporated in the minimum payment. Now, if you do that, we want to see the impact of on the minimum. So now, this is the minimum, and this is the finance charge. So only 34.24 goes into reducing your balance. Is that okay? So really, this will only reduce the balance on the card. What is the beginning balance? So now, if you take that out, that is your beginning balance. So though you pay 91.72, okay, your balance is just reduced by this because the finance charge is incorporated in the new balance. Is that right? All right, nice. Now, what can you conclude so far about only making the minimum payment each month? So if you only stick to the minimum, this is what happens. A very small portion of the balance gets paid off. Mostly interest is paid. Think about it. Did you just realize that? I can take a step back. So look at it. So this is a very good takeaway. Note closely. A very small portion of the balance gets paid off if you just stick to the minimum. Mostly interest is paid. Okay, so typically, this is what you will see in your test in an exam scenario. I'll give you a table like this, and I'll give you this information. So what we just looked at, right? You put everything on this table. So you do the finance charge. So the finance charge that we just found, okay, you put that there. So this plus that equals that. Now the minimum you do 3% of that, that gives you the minimum. So to know your opening balance for month number 2, you just you subtract that, and that gives you that. Is that okay? Now you keep the process going again. So now you do the finance charge for month number 2. So you do the APR divided by 12 multiplied by the opening balance. Okay, you add that together, and that gives you the new balance. Okay, and now you do the minimum, which is 3% of the new balance. Now you take 90.68 from that, and that gives you the opening balance for the 3rd month, and that is that. Okay, and again, you repeat, you do the APR divided by 12 multiplied by this opening balance, and that gives you the finance charge right there. And now you add the 2 together, and that gives you the new balance. So you keep the process going, you keep repeating. Is that okay? And that gives you your balance for the 4th month. So typically, that is how a test, okay, a question on a test will be like. Is that okay? Nice. Now use the values calculated in the previous table to answer the following questions. Now, what is the total of the minimum payment for the first 3 months? So you put the total of the minimum payment for the first 3 months together. So you put all of them together, and what's the total finance charge? You sum all of them. How much was the balance? Okay, after the 3 months, and how does your answer A relate to the answer to part A and B? Now, what percent of your payment went to finance charges over the 3 months? So you have to do that. So finance charge over the total of that, and about 63%, okay, went into finance charges just by paying the minimum. See, so now let's do a reflection. We want to review the credit card examples in this activity and explain how to avoid paying any monthly finance charges. How do you avoid any monthly finance charges? How do you avoid that? Can you answer? All right. Pay the balance in full. Is that what you taught? Nice. Who benefits most, the lender or credit card user, when only the minimum monthly payment is made, and why? Who benefits? The credit card company. Is that okay? Now, what are some consequences? Okay, consequences of poorly managing a credit card. A poor credit card rating can mean higher interest rates later and greater overall cost. What are some positive aspects of responsible use of credit card? Okay, so this is a reflection we have. Okay, we just had to reflect on these. Okay, nice. All right, so far so good. Okay, so be mindful when you want to take a credit card. And I was going to tell you that this is what I do. It's usually for most credit cards, they tell you, okay, we're giving you this credit card, and for 18 months, you will not pay any interest. Interest will start kicking in after 18 months. So they give you an APR after 18 months, and that is how I take it. So if I want to take a credit card, I would take a credit card like that. So if I read the agreement and it's fair, within 18 months, I can buy something and decide to pay in installments. So by the time the interest kicks in, I would be done. I would have finished paying, right? So then I don't have to pay interest on how much I spent on the card. And that is how I get away with interest on credit cards. Okay, nice. So Excel and minimum payment. So really we can use Excel to do these calculations that we just looked at on the table. And these are simple processes. They are well outlined here for you. and you can use that to do that. All right. Now, explore accumulating charges. So Mike has a credit card he rarely uses, but he accepts an offer to enroll in a credit monitoring service. So the service is free for the first few months, but then starts charging him a recurring fee of $20 each month. His card charges 18.99 APR. Now, Mike has set up an automatic bank payment that covers the required 7% minimum. The table below will be used to track what would happen after a few months of automatic charges or automatic payments. Okay. And the starting month, he zero, right? He had no balance, so no finance charge, and then 20. And by the fifth month, that is how much Mike needs to pay. All right. So work through these, and that completes Mike's example. So these are we're trying to explore, right? Average daily balance. Okay. Now, banks use this a lot. So if they want to give a loan to the customer, they will look at the average daily balance of the customer. When I worked in the bank, we had to do all these analysis, and usually systems, the computer, you do stuff like that, will show you the average balance, and that is what is used to determine how much a customer has kept. Now, use weighted average to calculate the average daily balance on this account. Okay, so, and we did weighted averages. So if you have an APR of 22.99, if you want to find the finance charge on that, you do the APR divided by 12 multiplied by the average balance, and that is it. Okay, now these are practice problems, and you have to find the finance charge, okay, with an APR of 23.99 on a balance of 600. So you do that, you change that to a decimal and divide by 12 and multiply by the balance, and that gives you the finance charge of $12. Okay, is that okay? Sweet. Number 2. All right, so here we have, so like I said, typically this is how a test problem will look like. Now, APR of 15.99 and a minimum of 5%. So note where to apply each of these rates. Is that okay? So we are going to do, so for here, we are going to do an APR of what? 15% on the beginning balance. So we will do 0.1599 divided by 12. Okay, multiplied by the opening balance of 1,000. And that will give us the finance charge of that. So that gives us the finance charge. Now we add the finance charge, okay, to the opening balance, and that gives us this much. Now we apply 5%. So here, this value, we did 5%, which is 5 over 100 multiplied by 1013.33. And that gave us this guy. Now, to find the beginning balance right here, now we subtract the minimum. We take this from that. So now we do this subtraction. 13.33 minus 50.67, and that gives us that. Is that okay so far? Nice. Now, this is your beginning balance. So now right here, you do the APR, which is 0.155599 divided by 12, multiply by that, and that gives you this finance charge. Now you add this finance charge to the beginning balance, and that gives you that. So over here, you now do 5% of that, and that gives you that. So you keep repeating the process. And now for the third month, you have to subtract this from that, and that gives you that. And now you do 15%, 15.99% over 12 multiplied by this, and that gives you the finance charge. So you keep repeating the process, basically. Okay, and that brings us to the end of our discussions on credit cards. Is that okay? So, so far, we have been looking at credit cards, and we have said that the most important thing you have to do is to be able try your best to read all the fine prints on a credit card. Take note of late payments, over the limit, charges, okay? And be mindful, it will be possible you pay online, okay? That would save you late payments. Is that okay? Because if you had to mail your card, your check or whatever, it could delay, and that could result in a late payment fee. Okay, so manage your credit cards very well, and make sure, put it at the back of your mind that credit card companies are here to make money. Okay, and the least mistake you make, you might end up being perpetual debt. Is that okay? So thank you very much for your time, and I will see you soon for us to discuss loans on section 11. Is that okay? So thank you, and do have a good day.